Welcome back to the Deep Dive. Today we're plunging into, well, a really compelling question shaping the digital world right now.
Yeah, it's a big one.
In a landscape where, user privacy is becoming paramount and the old ways of tracking with third-party cookies are basically crumbling, how does a marketing tech company not just survive, but actually thrive, dominate even?
That is the multi-billion-dollar question, isn't it? And our deep dive today, it's going to look at a company that seems to have found a pretty powerful answer.
Okay.
We're going to uncover how Zeta Global, that's ticker ZAT, isn't just navigating this really complex environment, but potentially thriving. We'll even touch on how its intrinsic value might be, well, quite a bit higher than its current market price.
Interesting.
Yeah, and you'll see exactly why Wall Street seems caught in this fascinating tug of war over its future. It's a real battleground.
Absolutely. So our mission today is to cut through all that noise, deliver the most impactful insights about Zeta Global Holdings Corp. It's all drawn from a comprehensive deep stock research methodology report.
Right, very thorough stuff.
And just so everyone's on the same page, all the data we're discussing is anchored to July 25, 2025. That day, Zeta closed at $16.04.
Good context.
Think of this as your shortcut, your way to get incredibly well informed on Zeta's position in this rapidly evolving AI-powered marketing landscape. Yeah. So let's unpack this.
Right.
All right, let's kick things off with Chapter 1, Business Understanding. So what exactly is Zeta Global's core business? How do they make money?
Right. So at its heart, Zeta Global positions itself as an AI-powered marketing cloud. Their big aim. To simplify what's become a really complex world of data-driven marketing, especially for their large enterprise clients.
That makes sense. And the revenue model?
It's actually quite robust. They use a hybrid recurring revenue structure. So roughly half their revenue comes from subscriptions, long-term software access, platform fees, often with minimum spending commitments built in.
Standard SaaS stuff, mostly.
Pretty much. But the other half is usage-based. So clients pay based on the volume of activities they actually perform, how many emails they send, ads displayed, things like that.
Okay.
And this hybrid approach is really key because it means Zeta's revenue scales directly with their customers' success. As their clients do more marketing and hopefully grow, Zeta grows right along with them.
That hybrid model sounds, incredibly resilient. But to get that scale, they must have some seriously powerful tools, right? How does this omni-channel platform actually unify, a marketer's chaotic world?
Good question. The central piece is the Zeta marketing platform. They call it the ZMP. They relaunched it back in 2019. And it really is designed as an all-in-one solution to unify those fragmented marketing efforts we all see.
Fragmented is putting it mildly sometimes.
Right. I mean, imagine a company trying to manage email campaigns, social media ads, maybe connected TV placements, website personalization, often using like a dozen different disconnected tools. It's just inefficient, often ineffective too.
Totally.
So the ZMP brings it all together. It does this with three core capabilities. First is identity. That means creating a single, unified view of each customer from all those scattered data points.
The holy grail for marketers.
Pretty much. Second is intelligence. This is where their AI comes in, analyzing literally trillions of data signals to predict consumer intent and behavior. What are people likely to buy? When?
Okay, predictive stuff.
Exactly. And finally, activation. This lets them launch campaigns across almost any channel: email, social, CTV, web, mobile, all from one single interface.
Wow.
And powering all of this is their secret sauce, the Zeta Data Cloud. It's a huge proprietary database that fuels their AI. Oh, and they also offer managed services for clients who maybe need more hands-on operational support.
That sounds like some serious scale and sophistication. Are they like a niche player, or have they really established themselves among the big leagues?
Oh, they are definitely a significant player, particularly with large enterprises. They serve over 450 what they call scaled customers.
Scaled customers.
Yeah, that just means clients generating at least $100,000 in revenue over the last 12 months. And their customer base is impressively diversified. Think financial services, insurance, auto, retail, telecom, the big sectors.
So pretty broad reach.
Very broad. And get this. They serve nearly half of the Fortune 100 companies. Plus, they're consistently recognized as a market leader by independent firms like Forrester and Gartner. They've got a global footprint, too. 15 offices, 11 countries, over 2,100 employees. So yeah, this isn't some small startup anymore. They're a major force.
Okay, so they're big, they're global, got this all-in-one platform. But, at the end of the day, what's the main takeaway for their customers? Why do businesses actually choose Zeta, especially when budgets are tight.
Yeah, good point. It really boils down to one critical factor: demonstrable return on investment, ROI.
The bottom line.
Exactly. In today's economic climate, every single marketing dollar needs justification. And Zeta helps clients, big names like Walmart and FedEx are examples, boost their customer lifetime value by a pretty impressive 20% to 40%.
That's significant.
It really is. And when you can show that kind of tangible, measurable impact on a company's bottom line, you shift from being just another, discretionary expense to being an absolutely essential, high ROI tool. It becomes a need to have.
It's clear they deliver that tangible ROI, which is crucial. But, no company exists in a vacuum, right? What are the macro trends shaping the very landscape Zeta operates in? Are they riding a wave or, battling headwinds?
Oh, they're squarely riding some powerful waves. Zeta operates in these massive, rapidly growing markets. Take the global marketing automation market, for instance. It was over $7 billion in 2025.
Wow.
And it's projected to hit nearly $17 billion by 2032. That's like a 12.8% compound annual growth rate, CAGR.
Solid growth.
Very solid. And even more explosive is the customer data platform, the CDP market. That's a key capability for Zeta. That market's projected to grow from about $9.7 billion in 2025 to over $37 billion by 2030. That's a blistering 30.7% CAGR.
Whoa, okay, that is explosive.
Right. These aren't just big numbers. They represent these fundamental shifts in how businesses have to operate now.
So what's the key factor driving that kind of rapid expansion in these markets?
Well, there are really two powerful tailwinds propelling this growth. First, you've got the end of the third-party cookie.
The big one everyone's talking about.
Exactly. Major browsers like Google are phasing them out because of privacy concerns. And this has made first-party permission-based data, which is exactly the kind Zeta specializes in, incredibly valuable. Gold dust, almost.
Makes sense. And the second tailwind?
The proliferation of artificial intelligence. AI isn't just a buzzword here. It's actually a necessity now for processing the huge volumes of data needed for hyper-personalization. That's what modern consumers expect, right?
Absolutely.
So companies like Zeta, with AI deeply integrated into their platform, are just perfectly positioned to gain significant market share as others kind of struggle to adapt.
These tailwinds sound incredibly strong, almost like Zeta has the wind permanently at its back. But of course, no company operates without challengers. Who are the heavyweights they're duking it out with? And how do they even stand a chance against some of those tech giants?
Yeah, the competitive landscape is, intensely fierce. You've got the marketing cloud behemoths, Adobe, Salesforce, Oracle, huge resources, established client bases.
Right, the big players.
Then you have point solutions, companies that specialize in just one area, like MailChimp for email or Twilio Segment for CDPs.
Okay.
And finally, there are the ad tech platforms like The Trade Desk, even Google, competing for those same marketing budgets.
So how does Zeta differentiate?
Their strategy is really to offer that integrated, all-in-one platform powered by their unique data and AI. They aim to be the comprehensive solution, arguing they can offer better ROI by bringing everything under one roof instead of stitching together lots of different tools. It's like Zeta has a secret weapon up its sleeve. It's data.
Speaking of data, the regulatory environment around data privacy, GDPR, CCPA, it's constantly evolving. How does that impact Zeta? Is it more of a burden or maybe a benefit?
That's a critical point. These regulations are absolutely vital. And honestly, it's kind of a double-edged sword for the whole industry.
How so?
Well, compliance costs are high for everyone, no doubt about it. However, it actually turns into a significant competitive advantage for Zeta. Their entire data foundation, as we said, is built on this privacy-first and opt-in approach. Consumers have willingly shared their data.
Right, that permission-based.
Exactly. So that makes them inherently better positioned to navigate these complex, evolving laws compared to maybe competitors who relied on less transparent data acquisition methods in the past.
So this privacy-first model really positions them uniquely. But what about barriers to entry? What protects incumbents like Zeta from new players trying to jump into this obviously booming market?
The barriers are pretty formidable, actually. First, high capital requirements. Building a global AI-powered platform like this, it costs hundreds of millions in R&D infrastructure. It's not cheap.
Definitely not a garage startup thing.
Not anymore. Second, economies of scale. Zeta can spread its huge fixed costs over a massive client base. That makes it really hard for smaller players to compete on price alone.
Makes sense.
Third, and this is maybe the most crucial, data scarcity. In this post-cookie world, trying to replicate Zeta's vast proprietary permission-based data cloud from scratch, it's nearly impossible. Think about it, you just can't buy that kind of consumer data anymore, not ethically or legally at scale.
Good point.
And fourth, high switching costs. For large enterprises, integrating their complex marketing operations into a platform like the ZMP, well, the time, the cost, the sheer operational risk of switching vendors are immense. Once they're in, they tend to stay put. It's sticky.
All those barriers sound pretty solid, but every good company needs a competitive advantage beyond just, protection. What truly sets Zeta apart? What gives them that distinct edge?
Well, there are several things. First, their brand strength and recognition. Now, they might not be a household name for consumers, but they are highly recognized by enterprise marketing execs.
The target audience knows them.
Exactly. Gartner and Forrester consistently recognize them as a leader in their categories. And they're actively raising their public profile, too. You see high visibility marketing, like their recent Zeta Live 2025 conference. They had keynotes from Tom Brady and Serena Williams.
Wow, big names.
Yeah, and their whole Achieve the Impossible brand campaign. So they're making noise. Then you have their cost advantages and economies of scale. Their SaaS model means the marginal cost of adding a new customer is incredibly low.
Right, both software model benefit.
And crucially, they own their entire tech stack. From data ingestion to the AI models to the activation channels, they own it all. This means they avoid a lot of licensing fees and margin stacking that competitors face if they're piecing together third-party solutions. It gives them a real structural cost advantage.
Okay, that makes sense. Anything else?
And finally, a powerful combination of network effects and high switching costs. Zeta benefits from this kind of flywheel effect.
Explain that.
Okay, so their integrated platform attracts more clients. Each new client adds their first-party data, which makes Zeta's AI engine smarter, makes its predictive analytics more accurate for all clients.
The data makes the AI better for everyone.
Exactly. Better results for clients leads to higher retention rates, increased spending from existing customers, which in turn attracts even more new clients. It's this virtuous cycle. And you can see it clearly in their 114% net revenue retention rate for 2024.
Meaning existing customers spent 14% more year over year.
Precisely. That's a very strong indicator of that flywheel working.
That's a very clear stickiness indicator. But what about truly unique assets, capabilities that competitors just can't easily replicate? What's their undeniable moat, their castle wall?
Yeah, that would absolutely be their proprietary data cloud and its patented AI engine. As of 2021, their data cloud had over 2.4 billion unique identities globally.
2.4 billion.
Billion, yeah. And to put that in perspective, the U.S. portion alone has over 235 million opted-in individuals. And each one has an average of more than 2,500 demographic and behavioral attributes.
Wow, that's deep data.
It's not just big data, it's highly curated, it's permission-based, and it's updated constantly. They ingest over 1 trillion new content consumption signals globally every single month. That fuels their AI. This asset is just nearly impossible to replicate from scratch today, especially with privacy rules. And it powers their patented AI engine, giving them a significant predictive edge.
That's quite the competitive setup. Okay, let's move to Chapter 2, Management Evaluation. Who's leading this charge at Zeta? Do they have the right people at the helm to actually execute on this big vision?
Absolutely. The company is led by its co-founder, chairman, and CEO, David A. Steinberg. Now, he's a serial entrepreneur, 30-plus years of experience, founded 5 companies, took 2 public, including Zeta itself.
Okay, so he knows how to build and scale.
That track record speaks volumes, yeah. And crucially, he has significant skin in the game, owns a stake worth hundreds of millions. That ensures strong alignment with shareholders.
Oh, that's good to see. Who else?
Their CFO is Christopher Greiner. He brings over 2 decades of experience, including executive roles at IBM, CFO at other public tech companies. His expertise isn't just finance, it's operations too, giving him a holistic view.
Solid team. And their track record.
Well, this leadership team has proven they can navigate tough environments. They managed over 20% revenue growth during both the COVID pandemic in 2020 and the tech downturn in 2022.
That's impressive resilience.
It really is. That kind of performance in challenging times is incredibly important for a growth company like this.
That's a solid history.
Yeah.
How transparent is management with investors? Do they, underpromise and overdeliver, or is it the other way around?
They've actually established a remarkable pattern of consistency. It builds significant trust. As of Q1 2025, they delivered 15 consecutive quarters of beat and raise results.
15 straight quarters.
15. That tells you they tend to provide conservative guidance and then consistently outperform their own expectations. They also have their Zeta 2028 plan, which outlines a clear long-term vision. It shows how current actions like AI investments and acquisitions tie into future targets.
It's good strategic view.
Yeah, and ethically, their public emphasis on that privacy-first, opted-in data set is a critical part of their reputation, especially in an industry often under scrutiny. It aligns with where consumers are heading.
Speaking of investments and acquisitions, how are they allocating capital? Are they aggressive with M&A or more focused on organic growth?
They're quite strategic with their mergers and acquisitions. They've done over 10 acquisitions so far. Their capital allocation is really squarely focused on strengthening the core business, enhancing that competitive moat we talked about.
Any recent examples?
Yeah, a great one is the Live Intent acquisition back in October 2024 that brought in a valuable publisher network, which further enhances their activation capabilities and reinforces that flywheel effect.
Got it. Dividends.
No dividend, pretty typical for a high-growth tech company. They believe reinvesting that capital back into the business yields higher long-term returns for shareholders.
Makes sense. What about buybacks?
Ah, yes. They are actively returning capital through a share buyback program. In November 2024, they authorized $100 million for buybacks.
Okay.
And they moved quickly. They repurchased $31 million worth in Q4 2024 alone, totaling $41 million for the full year. And management explicitly stated they believe the stock was trading substantially below what we believe it's worth. That shows strong conviction, especially while still reporting those GAAP losses.
It's certainly bold to buy back shares while reporting GAAP losses. That requires immense conviction, as you say. But for a growing company, investors often look at return on invested capital, ROIC. What does ROIC tell us? And should we be concerned it's currently negative?
Right, good question. Currently, their ROIC is negative. It's sitting around negative 3.62% on a trailing 12-month or TTM basis. However, this isn't really uncommon for a hypergrowth company like Zeta. They are heavily investing in sales, marketing, R&D to capture this massive market opportunity. These big investments depress near-term accounting profits and, yeah, consequently, the ROIC.
So it's an investment phase dip?
Exactly. The key for investors is really to monitor this metric for future improvement. The expectation, the hope, is that these investments will eventually translate into substantial profits and a rising ROIC as the company gains scale and matures. You're betting on the future payoff.
Got it. Let's shift gears then to Chapter 3, Financial Analysis. Let's review the key numbers that really tell Zeta's financial story. What's their market cap and how fast is that revenue actually growing?
Right, numbers time. As of our analysis date, July 25, 2025, Zeta Global had a market cap of $3.78 billion. That puts it squarely in the small to mid-cap space.
Still room to grow, potentially.
Definitely suggests that, yeah, if their strategy plays out. And speaking of growth, their revenue has been rapid and consistent. Fiscal year 2024, revenue crossed the $1 billion mark, hitting $1.01 billion. That was 38% year-over-year growth.
38% is strong.
Very strong. And that momentum continued into Q1 2025. Revenue hit $264.4 million, up 35.6% year-over-year. Management's guidance for the full year 2025 is between $1.235 billion and $1.245 billion. That still implies strong growth of 23% to 24%.
That's impressive top-line growth, no doubt. But what about profitability? Are they actually making money on the bottom line, or is this a growth-at-all-costs story?
Yeah, that's where the financial picture gets, let's say, interesting. Their gross profit margin is healthy, really healthy, actually 60.36% on a TTM basis. Shows the core service itself is very profitable.
Okay, good start.
However, their operating profit margin is negative, -3.42% TTM. And their net profit margin is also negative, -4.82% TTM.
So losses on the bottom line.
Yeah.
Why?
Well, the crucial insight here, and this is really important, is that these negative net margins are primarily driven by a large non-cash expense. $195 million for stock-based compensation just in fiscal year 2024.
Stock comp again?
Yeah, it's a common way high-growth tech companies reward employees and execs without immediately impacting their cash balance. But it does hit the GAAP bottom line.
So on paper, they're reporting losses, largely due to these non-cash expenses. How does that translate to actual cash in the bank? What does their free cash flow look like? Is that maybe a better indicator of their financial health?
That's a great question, and it tells a much more positive story. While those GAAP earnings show losses, Zeta's free cash flow FCF generation has been on this really powerful upward trajectory.
Okay, let's hear it.
They generated $55 million in FCF back in 2023. That surged by 67% to $92 million in 2024.
Wow, big jump.
Huge jump. And the momentum kept going into Q1 2025 FCF was $38.45 million, a 32% increase year over year. This strong, accelerating cash generation is arguably the most important financial indicator for a growth company like Zeta.
Why is that?
Because it demonstrates that the underlying business is economically sound, it's highly cash generative, despite those accounting losses from stock comp. The cash is real. If you look at the summary table provided in the research, you can clearly see FCF turned positive from negative back in 2021, and it's grown consistently ever since. That signals a maturing, strengthening business model.
That FCF trend certainly paints a different picture than the net profit. How's their overall financial stability then, looking beyond just the cash flow? Do they have a strong balance sheet? Are they loaded with debt?
No, their balance sheet is actually very strong. While GAAP earnings are still negative, remember that adjusted EBITDA, which excludes non-cash items like stock comp, is consistently positive and growing rapidly. It was up 49% to $193 million in 2024.
Okay, that's a better profit measure here.
Arguably, yes. And their debt-to-equity ratio is super low, just 0.31. That means they rely far more on equity than debt, which significantly reduces financial risk. Less leverage.
Good sign.
And their current ratio is exceptionally strong at 3.33. That shows robust short-term liquidity, meaning they can easily cover their short-term obligations. Plenty of working capital. And as we noted, no dividend, which is typical for a company reinvesting heavily in growth.
Okay, that gives us a good handle on the financials. Now that we've grounded ourselves in Zeta's fundamentals, let's shift gears. Time for part 2. We'll start with chapter 4. Market sentiment. What's Wall Street's general take on Zeta Global? Are analysts bullish, bearish? What are the headlines saying?
Right. Well, the analyst community is overwhelmingly bullish on Zeta. The consensus rating from the 14 brokerage firms covering them is a strong buy. The average brokerage recommendation, or ABR, is 1.57, which is very positive.
Their price targets.
Their average one-year price targets fall in the range of $25 to $30. Now, remember, the stock was at $16 on our analysis date. So that implies a potential upside of, 55% to 85%?
Significant upside implied there.
Yeah, and some of the most optimistic targets go even higher. We saw ranges from $44 up to $46.20. The general media tone is also largely positive. Headlines frequently highlight that 15th straight beat and raise quarter we talked about, new AI products like their AI Agent Studio, and those high-profile marketing efforts with Tom Brady and Serena Williams.
So the media narrative is pretty positive, too.
Generally, yes. They're largely framing Zeta as a key beneficiary of these big AI and data-driven marketing trends.
That's a very positive outlook from the professional community, the analysts, the media. But is there a contrasting view out there? What does this short interest look like? Are there parts of the market that aren't so convinced?
You're absolutely right to look for the other side of the coin, and here's where it gets really interesting. In stark contrast to that analyst bullishness, there's a significant segment of the market betting against Zeta. The short interest is very high, 15.04% of the float.
15%, that is high.
It screams battleground stock scenario. The bears, the people shorting the stock, are likely focused on that gap unprofitability, the high stock-based compensation causing dilution, and maybe those intense competitive threats from the tech giants we discussed.
So a real division of opinion.
Absolutely. This divergence creates a fascinating high-stakes tug-of-war in the market. And often, for a long-term investor, this kind of divergence can sometimes point to a potential mispricing, one way or the other.
Interesting. What about technical indicators? Price momentum.
Yeah, looking at the technicals adds another layer. The stock price, $16.04, was actually trading above its 50-day simple moving average, which was $14.28 at the time. That's generally seen as a bullish short-term momentum signal. Maybe recent positive news was having an impact.
Okay, short-term positive.
But the price was still trading below its 200-day simple moving average, which was $18.33. And that's typically a bearish long-term trend signal. Also worth noting, the stock's 52-week high was way up at $38.20.
So it's been in a longer-term downtrend despite recent strength.
Exactly. It paints this really fascinating picture. Recent positive momentum bumping up against a longer-term downtrend. It puts the stock at what you might call a critical technical inflection point. The bulls really need to press their advantage here to break that longer-term trend.
That's a truly captivating dynamic. Okay, let's move to Chapter 5. Ownership structure. Who actually owns Zeta Global? Is it mostly big institutions, or is there significant insider ownership, people running the company?
Right. The ownership is heavily concentrated among sophisticated financial institutions. We're talking 69% to 84% of the outstanding shares held by institutions.
Wow, that's a lot.
It is. It's a strong vote of confidence from professional money managers. The top two institutional holders are the Vanguard Group, holding about 9.1%, and BlackRock, with roughly 6.8%. These are typically long-term holders, which can provide a stable ownership base.
Okay, strong institutional backing. What about insiders?
Insider ownership is also significant. It represents somewhere between 12% and 20% of the outstanding shares. And CEO David Steinberg himself is the largest single shareholder with about an 11% stake.
11%. That's definitely skin in the game.
Absolutely. That level of ownership strongly aligns his interests with other shareholders. Management is truly working for the owners, including themselves. And here's where it gets really interesting on the insider front.
Oh.
Back on November 18th, 2024, there was a coordinated cluster buy. Multiple top executives and directors, including the CEO, the CFO, the president COO, they all bought shares on the open market around the same time.
A cluster buy, what does that signal?
It's generally seen as a very powerful bullish signal. It indicates a shared internal conviction among the top leadership that the stock was undervalued at that time. The stock was trading around $19 per share then, remember.
Higher than it is now. Interesting.
Very interesting. Overall, the top 12 shareholders collectively own 50% of the company. So you have a very well-aligned and concentrated shareholder base here.
That insider buying is certainly compelling. Strong belief from the inside. Okay, let's pivot now to Chapter 6, risk assessment. We've talked about a lot of positives, but every company faces challenges. Let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats for Zeta Global. What are the core strengths?
Okay, quick SWOT. For strengths, number one has to be their proprietary data cloud and AI engine. Truly unique, defensible assets, especially now. Second, that integrated platform creates high switching costs, makes customers sticky. Third, it's founder-led, proven track record, strong alignment. And fourth, their financial position, healthy balance sheet, rapidly growing free cash flow. Those are the core internal competencies.
And what about the internal limitations, the weaknesses that could hold them back?
Okay, weaknesses. The big one is the gap on profitability. Even with strong FCF, those bottom line losses deter some investors. Second, the heavy reliance on stock-based compensation, which causes significant dilution for existing shareholders over time. And third, as we discussed, that negative return on invested capital, showing those heavy growth investments haven't hit positive accounting returns yet.
Now for the exciting part, the opportunities on the horizon. What potential can Zeta capitalize on?
The opportunities are immense. First, they operate in a huge and rapidly growing market driven by the digital shift and AI adoption. Second, that post-cookie world. It's a massive opportunity for them to gain market share with their first-party data advantage. Third, AI advancements create constant upsell potential new features like their AI Agent Studio. And fourth, that strong balance sheet means they can pursue further strategic M&A in what's still a pretty fragmented market. They could be a consolidator.
Finally, what are the external challenges? The threats that could really challenge Zeta's trajectory, even with all these advantages.
Okay, the threats. First and foremost, intense competition. We mentioned Adobe, Salesforce, Oracle, Google. These are well-capitalized giants with vast resources. That's a constant battle.
Can't ignore them.
Absolutely not. Second, the rapidly evolving data privacy regulations. It's that double-edged sword again. While Zeta seems well-positioned, compliance costs can rise, new laws could impact data use unexpectedly. It's a moving target.
Always a risk in this space.
Definitely. Third, macroeconomic factors. If there's an economic slowdown, marketing budgets are often among the first things cut. That could impact Zeta's growth. Inflation, interest rates also play a role.
Standard macro risks.
Right. And finally, maybe some geopolitical factors. Hypothetically, things like U.S. tariffs could impact their multinational clients. And there's also a cyclical risk from U.S. political advertising. They get a revenue boost in election years, but then face tough comparisons in non-election years. That can cause stock volatility.
We've covered a lot of ground today, really peeling back the layers on Zeta Global. Let's bring it all together now for Chapter 7. Conclusion. Can you summarize the core of the bull case for Zeta Global? Why would someone be optimistic?
Sure. The bull case, in a nutshell, is this. You have a high-growth, founder-led company operating with a durable and arguably widening competitive moat. That moat is built on their unique, proprietary, permission-based data and their patented AI assets becoming incredibly valuable in this privacy-focused post-cookie world.
Right.
They're benefiting from major industry tailwinds like AI adoption, their business models proving financially scalable, generating substantial and rapidly growing free cash flow. They have a fortress balance sheet, and you've got an aligned management team with a consistent track record of execution who are actively repurchasing shares they believe are undervalued. That's a compelling package.
And for those who are skeptical, what's the counterargument? The bear case.
The bear case rightly highlights the hyper-competitive industry. Going up against trillion-dollar tech giants is no small feat and shouldn't be underestimated. There's the ongoing JAP unprofitability, which worries some investors. There's the significant stock-based compensation leading to dilution. There's the ever-present regulatory risk around data privacy. And of course, that very high short interest, we discussed it, indicates that a large, sophisticated segment of the market remains skeptical about Zeta's ability to win long-term.
So after crunching the numbers, doing all this analysis, what's our estimated intrinsic value for Zeta Global stock?
Based on our discounted cash flow analysis, which importantly anchors pretty closely to management's own Zeta 2028 financial plan, and targets our analysis, suggests an intrinsic value for Zeta Global stock in the range of $19 to $24 per share.
And the key assumptions behind that range.
Key assumptions include revenue growing at a 20% compound annual growth rate through 2028, seeing their free cash flow margins expand to around 16% by 2028 as they scale, and using an 11.5% discount rate to account for risk.
And just to remind everyone, as of our analysis date, July 25, 2025, Zeto's stock price closed at $16.04. So that puts the current price below the lower end of that estimated intrinsic value range. So what does this all mean for you, the listener, trying to figure this out?
Well, the ultimate investment decision here really rests on your assessment of the balance between these compelling bull and bear cases. Zeta is clearly a high-quality, high-growth business, but it's at a critical juncture. The market is very clearly divided on its long-term prospects right now, with strong arguments, frankly, on both sides.
Which leads to maybe a final provocative thought for you to consider. Given Zeta's unique data asset in this privacy-first world, how much of its future success really hinges on truly converting that massive data scale into measurable, hyper-personalized experiences that even the tech giants, with all their resources and broader ecosystems, just can't replicate? Can they turn that data into an unbeatable advantage? And that's our deep dive into Zeta Global. If you found this valuable, and we hope you did, we invite you to like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority deep dives on tickers you request. Plus, over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access to those.
Yeah, tons of great content coming.
And if you just want a one-off deep dive on a specific ticker that's caught your eye, just drop us a super thanks on the video.
And as always, please remember, this analysis was generated by an AI system for educational purposes only and should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks so much for joining us on this deep dive. We look forward to exploring the next fascinating company with you very soon.